Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. I'm so glad you're here. What do we got going on? Well, we got a market that's kind of just moving sideways so far. This year's going to be very volatile. It's going to be a lot of up, a lot of down, but right now, not so much, kind of just sideways. We'll see how this plays out, but I think the stock market is actually at a tipping point. I think it's getting ready to fall over. Now the Dow right around 50,000, the S&P right around 7,000. Can they hold that? I don't think so. I think they lost their leader. Their leader was Nvidia, right? Nvidia peaked out at $5 trillion. $5 trillion, right? And I mean, it was at $212 a share. Now we're back in, 185, 190? I'm not even sure what it's at today, but I know it's not back at record highs. They've lost the leader. The leader's gone, and it's not going to be coming back anytime soon, in my opinion, which is going to cause the stock market to tip over. We'll see how this plays out. It'll take a little time to see what happens this year, but I think we're going to get a pullback at 30% or more. Just my take. All right, let's get over to the real estate market. We haven't talked about the real estate market in a little while. Anyways, Redfin, they came out with information for us, right? They say that there's 37% more sellers than buyers. Well, that's interesting. If you got more sellers than buyers, what's going to happen to prices? Prices will come down, right? Right now, the sellers aren't that motivated yet. Soon they become motivated, then they become desperate. But there's no demand. No demand for houses up here, demand for houses down here. I agree with that. A lot of demand. Once you drop 30, 40, 50% in the housing market, you're going to get demand. People want to own a home. Now, it's fascinating to me. Back in the 70s when I was growing up, the average 30-year-old, anyways, over half of them own their own house. Of all the 30-year-olds back in the 70s, half of them were homeowners. Actually, over half of them were homeowners. You move forward to today, and you take all the 30-year-olds today, what percent of them own their own home? It's only 12%. 12%. Went from 52% down to 12%. What happened? Well, they can't afford to buy a home. Isn't that fascinating? The home ownership, it's become unaffordable for a whole generation of people. So they wait longer and longer. They wait into their 40s. 40 years old is about the first time home buyer now. I bought my first house at, I was barely 21. Might have even been 20 21. We'll go with 21. But anyways, I bought my first home and I liked it. It went up in value. Anyways, I sold it and went and bought a bigger, nicer one. Today, they don't have that mobility. They don't have that movement. Once you buy the home, right, all those people that bought back here, they're real excited because they're locked in at their mortgage rate at 2.8%. But when they go to sell, they can't sell because, well, then they got to pay 6.5% right now, right? But don't worry. Donald, he's got a good plan. It's a three-part plan. Let me go over this with you to make homes more affordable, right? So anyways, they're bringing out the 50-year mortgage. Now, does that make homes really more affordable? Maybe it'll save you $50 to $100 in your monthly payment. But all it really does is help the banks out, right? I mean, more money for the banking system. 50-year mortgage, let's say you bought it at 30 years old. You'd be 80 by the time you get it paid off. It'd be just like renting a house, right? Renting a house, you can do that for about half the cost of home ownership right now. And rents are actually starting to go down in most areas, which is why I believe that home prices will come down. 30, 40, 50%. They'll come down because they'll be following the rents lower and lower. And people will catch on to this, right? If your home's not going up in value, it's a stupid investment. Well, it's not really supposed to be an investment. It's supposed to be a place to live. But if it's not going up in value, you can live in the same type of house right next door for about half, right? In my area, it costs you about a third to live in the house right next door to the one paying. One guy's paying $30,000 a month. One guy's paying $10,000 a month. Or those are just rough numbers. I live in a very wealthy area, but in your area, I'm sure those numbers are a lot cheaper. But most areas, it's about half. Maybe the home to buy it's $5,000 and to rent it's $2,500 in your area. A month, the monthly payments, right? So why not just rent? Right now is a great time to rent. Now, I'm not supposed to say that because I'm a real estate broker. I'm supposed to say it's always a great time to buy because that's the first thing we're trained to say as a real estate broker, right? I mean, that's what they teach us in real estate school. It's never a bad time to buy a house. It's always good because all they do is go up and up and up. Oh, we've got that wrong, right? Go back to the great financial crisis. Oh, no, houses went down. Anyways, went down by 34%, but they didn't let it flush out, right? What'd they do? They started printing money, and they openly admitted they printed the money to blow up the bubble in the housing market. And they were successful. I got to give them credit, right? I mean, you print $20-30 trillion, you can blow bubbles bigger, and that's exactly what happened. They blew the bubble bigger. Okay, so we had the great financial crisis, and now the bubble's bigger, right? So they pumped air into the bubble, and they're going to continue to try to do this. But at some point, the bubble actually pops. Now, here's the thing. You see, I think Donald, he sees that the housing market is going to start to go down. Now, he can't have this on his watch. What's his next plan? Step 2, the first one, the 50-year mortgage. Step 2, what's that? Buy $200 billion of mortgages. Well, that's great, right? Where do we get the $200 billion from? Oh, we don't have it. We got to print it. Okay, let's print $200 billion and buy the mortgages. Well, actually, that's how we got into this mess. Biden, I think he bought $2 trillion, maybe $3 trillion at one time, right? Anyways, that's why we got the price of the mortgage rates, got them to come down to 2.7%, right? So we bought all the mortgages. No one in their right mind would loan 30-year money for 2.7%, but yet the Donald, he wants to lower them back to that rate. He's going to start to be the buyer of the mortgage-backed securities, 200 billion of them, just to get the ball started, right? So he can buy them. Maybe he'll buy another 2 trillion of these mortgages and get the rates down, right? But you see, here's the fascinating thing. $200 billion, that's not going to do anything. What's the average mortgage right now? Let's call it, I don't know, 6.25, right? Maybe it comes down to 6.2 from 6.25, we drop to 0.2. 200 billion is like, it's just not a big enough thing to even have an effect on it to make the houses more affordable. Would you go out and buy a home because your mortgage rate dropped from 6.3 down to 6.2? I don't think you would. I don't think anybody would use that in their decision-making process. And that's basically what the $200 billion is going to do. But I would even argue that the $200 billion could make it go up from 6.3% to 6.5%, because you see, we don't have the $200 billion, so we have to print more money. And when we print more money, that's inflationary. Now, the long end of the bond is going to start to see inflation, right? It's going to start to go up. Now, they're lowering the short end, and the Donald, he wants to lower those rates back down to 1%, down to 0%, but that's the short end, you see, because that's very inflationary. What's happened to the long end? Every time they cut the rates, seems like the mortgage rates are going higher. Isn't that interesting? Cut the short end, long end continues up higher. So when they do this to print the money, right, they have to borrow the money. Well, the long end is inflationary and it's going to actually go up. So it might have the counter effect. He wants to make homes more affordable, but it might actually make them less affordable by printing $200 billion to go out and buy mortgages. So I don't think that's really the idea. I don't think that's really going to help us out that much. So what's the third plan? Now, this is the big one, right? This is the big one. Okay, we're going to eliminate Blackstone and all these big companies, these big businesses from buying houses. Now, this probably would have been a good idea at the time, but right now they're net sellers. They're not buying anymore. Now, you see, here's what the Donald doesn't understand. Donald, if you're watching, I'm going to give you a little economics class here. You see, the problem wasn't allowing the big businesses to buy homes. homes. The problem was to keeping rates at 0% for 14 years, 0% interest rates for 14 years. So what could Blackstone do? Well, they could get all the money they want from the government at 1%. The government was giving Blackstone all the money they could handle at 1%. They're saying, go out there and invest it. Go out there and make money with it. Well, they don't have anywhere to make money with it. So what did they do? They all got their heads together, right? All the CEOs and all the board members, they got together and they go, we can get money at 1%, but we have nowhere to put it. We have nowhere to put the money. Well, let's put it into real estate. We can rent the houses out and get 4% on our money. And that's just, and the kicker here, okay, so they get the money at 1%. They make 4%. They get to keep the difference, right? But the kicker is the houses at the time were going up 10, 20% at a time. So they get to get all that money also. And this was great business, right? That's why all these businesses wanted to get out there and they wanted to buy these houses. But what's happened now? Well, the rates have started to go up. Now they got to pay 4 or 5%. Now let's just say they're paying 5% to get the money and they can only make 4%. And houses aren't going up anymore. They're starting to come down. Guess who the net seller of houses are? Big businesses. Now, it's not a problem, right? But Donald's going to outlaw them from buying houses. Okay, well, that maybe helps, maybe doesn't help. But the big business, they already got their houses. They are out there selling. They want out of the market because they see the writing on the wall. They see the prices are going to start to come down. In most areas, they're already coming down. Of course, not your area. You live in a very nice area where everybody wants to live and nobody gets divorced, nobody loses a job, and nobody dies. You live in a great area, so your area is going to continue to go up. But most of the country has started to come down already. So the big business is really not the problem, but the problem was lowering rates artificially. Now, here's an idea. Just a concept, just a wild idea, And I thought of this myself. Hey, how about getting the government out of the real estate business? How about letting the free market decide where mortgage rates should be? Letting the free market decide who gets to buy the house and who doesn't buy the house, right? And then you get this price discovery thing, right? If the government doesn't buy $3 trillion worth of mortgage-backed securities, we don't have this big bubble. We don't have this big problem. We don't have 30-year-olds that can't afford to buy a house until they're well into their 50s, which takes away the formation of the family unit because they don't want to get married because they got nowhere to live. Most girls that I know, they don't want to live in a car with you because you'd be homeless at age 30 and they don't want to live in your mom's basement. You got to get to the point where the 30-year-old can buy a house again, right? Only 12% of them own a house. When I was young, over half of us, we owned houses when we were 30. They formed the family units, right? You could go and get a wife, raise up a couple kids. You can't afford to do that today. No, it doesn't work anymore because they printed the bubble, right? They printed this bubble and this bubble's going to pop. Now, when does it pop? It pops when the long end of the bond market explodes higher. Watch for that. I mean, that's what's going to crash everything. It's not going to start in the stock market. The downfall, the problem is going to be in the bond market. It's already showing cracks. Nobody wants our bonds. Nobody wants to buy the long end. The long end is going to spike up. I'm telling you, it's going to go. Right now, what is it? 4 or 5%? We're talking it's going to go 8, 10, 12, 14%. And you're going to see this, and you're going to go, but the Donald, he's lowering the rates to 0, but the long end keeps going up and up and up and up and up. Well, this is where the problem comes. It's going to bring down the stock market, going to bring down the housing market. People think that houses are going to be great because we're going to hyperinflate. No, you're going to see the interest rate on the mortgages at 25%. Guess what happens? Nobody's going to buy your house. Now, you can go back to the days of the Great Depression. Houses only came down 25% in the Great Depression. In the Great Financial Crisis, we came down 34%. We came down more than the Great Depression. Well, guess what? This time we're going to come down 40, 50, 60%. And I might be conservative at that number. Why? Because the long end of the bond market's going to break, right? Long end of the bond market's going to break. What's going to happen when it breaks? The banks are going to topple over, right? They're not going to be able able to make mortgages, so no one's going to be able to get a mortgage to buy your house, right? They're just not going to have that happen. They're not going to be able to get the mortgage, so it's going to be a cash-only business. Well, you know what happens when it's a cash-only business? It goes down about 70%. But that's just my take, right? Maybe your take's completely different than this, but my take is that the house prices are going to come down. Now, that's when it happens. That's when it happens. I keep telling you, you want to put your money away in the silver. In silver. Look, at silver got expensive, right? It's almost $100. Okay, when I was telling you to do it, you could get 500 ounces of silver. Well, I don't know, it was $20, so $10,000. Now the 500 ounces of silver, it's going to cost you 50 grand, but you're going to be able to trade that 50 grand for the average price home, which right now is about 450,000, 50,000. You can still get the silver. See, that's why I say the silver is still a bargain down here, even at $100, right? $100 a coin, you get 500 of them. You're going to be able to swap it for the house. Now maybe silver goes up $300, $400, $500 an ounce. Maybe the house has come down 400, 300, 200. Maybe it all matches out, but I still think you're going to be able to trade 500 ounces of silver for the average price home. If you like this stuff, give me the thumbs up, punch the subscribe button, get out there, everybody. Have a great day. Bye-bye now.